Ladies and gentlemen, you are at the Yield and Lending panel. So I think we'll have a pretty exciting time. I'm going to open things up with the moderator prerogative. So just to set the table a little bit. So, one of the things I want to delve into is, where does yield come from, right? So I think just about everybody here in this room is probably collecting yield from somewhere, right? So you guys are collecting yield, right? So, congratulations. But where's the yield coming from, right? So what's the number one source of yield? Where does most of the yield in DeFi come from? Anyone? VCs. I'm a VC, so that's a good answer. Any other good answers? Okay, so according to Stani, the number one yield source in DeFi is money printing, right? Because there's so many forms of money being printed. So like a lot of the yield that's being generated is inflationary yield due to money printing. So that's one source of yield. What's the second largest source of yield in DeFi? I'm sorry, say it louder. Yeah, demand for leverage is actually, I think, number 3, because I will assert that the number 2 source of yield is people getting wrecked, right? And I like to tell people, if you are aping some protocol and you don't know where the yield is coming from, it's coming from you. You are the yield, right? So, so make it a point to know where the yield is coming from. Now, this gentleman over here actually gave a super important source of yield, which is this idea of leverage, which is someone else wants leverage, right? And so they're willing to borrow, and that borrowing produces yield because of time preference. So that's the third. And I think that source of yield is pretty awesome. Time preference, great source of yield. And in fact, the Austrian economist Eugene Böhm-Bawerk, a very cool dude, figured out that time preference is the source of yield, and basically interest yield. And so the point being that that's a big thing, is time preference. So if you have a long time preference, you'll always do better than someone with a short time preference, as long as your thesis is correct. So that's an important source of yield. And then ultimately, another source of yield is this primary yield of Bitcoin, which is that as long as governments print money, if you're on the right side of that equation, then you will also earn a form of yield. So I guess what I'd like to do is do the round robin introductions from the panel. So I guess I'll start as moderator. So my name is Miko. I'm a VC, early stage. Did invest in things like Celsius. That was a good one. OpenSea, Vega Protocol, 1inch, Credo Networks, OpenSea. So definitely a bunch of really interesting early stage companies. And I'm just really excited about DeFi stuff. So, if you're launching early stage DeFi stuff, come see me. So let's go this way. So we'll go here and then.
Hey, how's it going?
Robin.
I'm Seraphim. I'm head of risk at Euler Finance. We have permissionless lending protocol. We introduce some interesting stuff in the liquidation space, and hopefully you find the panel interesting.
Hi there. I'm Engin Erdoğan, based here in New York, and I work with Alchemy Network. I lead ecosystem and growth there. Alchemy Network is on a mission to bridge CeFi to DeFi to enable the big capital flow from centralized finance institutions into DeFi. Excited to be here.
JD, I am with Banky, which is a lending protocol on Avalanche. Excited to share some ideas with you guys. Most of the smart stuff's already been said, so hopefully we can add a little bit as the hour goes on.
I'm Sid. I'm the co-founder of Maple Finance. We're an institutional capital marketplace built on the Ethereum blockchain, and we recently crossed 500 million in TVL.
Fantastic. Woo. So I guess, just to kick things off. So, one thing is any kind of quick reactions, novel sources of yield, any kind of thoughts around yield and the previous rant that I gave.
On the previous panel, somebody said it comes from magic beans. It's probably that.
Magic beans. Yeah, that's
But-
good. That's good.
I think
Sid?
I think it's correct that the first source of yield is probably coming from printing money, printing
Yeah.
tokens. I'd say that the second largest source of yield is probably actually trading of those tokens. Like it's probably LP positions within DEXs and centralized exchanges as well. And then the third source of yield is obviously lending, which, as the gentleman alluded to before, trying to get leverage.
Yeah. So all you've done is you've renamed people getting wrecked as trading. But they're the same thing. I mean, 50% of people trading are people getting wrecked, right?
Yes and no. If you can't sell a coin, that's ultimately how you get wrecked, and so there's no
Correct.
trading occurring there.
Yeah, exactly. So lack of liquidity is one way to get wrecked, and then that's a person getting wrecked. Totally agree. And that's one of the downside consequences of rampant money printing, right? Is that there may not be liquidity for everything when you need to get out. So yeah, that's good. But it's a super legit taxonomy. So
But I think ultimately the most sustainable form of yield is probably, aside from the printing of new money, it's probably borrowing and using it for productive use cases.
yeah.
Lending is probably the most sustainable form of yield that we see in the space.
Yeah,
Obviously, I'm going to say that though.
No, it's fantastic. And your mic's coming in and out a little bit, but just to reiterate, yeah. So I think when I mentioned the Austrian economist Bamberg, right, he basically created this thing I call the Wimpy Effect, right, which is there's a character in Popeye called Wimpy, and his famous thing is I will gladly pay you Tuesday for a hamburger today, right? That's what Wimpy has to say, right? So the gladness of Wimpy is time preference yield, right? So the idea becomes if you have to have something now, you're always going to pay a premium, right? So that's time preference, right? So, but what you were saying is that if the person you're lending to is actually doing something productive, right, then that person is then able to pay back, right? So if they're not doing anything productive, then they're probably not going to be able to pay back, right?
Correct. Unless they're earning income from an alternative source. But I'd say what you hope is that they're borrowing to grow the pie, and then there is, there's income generated from that activity that they can use to repay the loan.
So one thing that might be an interesting aside, I know you guys have like a lot of really good DeFi juicy nuggets, so maybe I should try to banish this ghost early, is what is your hot take then on Axie Infinity and the play to earn world? And anyone else too.
Yeah, I think it's interesting what they're doing with play to earn, and same thing with even liquidity mining and some of this printing yield in the lending space and some of the things we're doing now. It's almost table stakes to get a certain critical mass of people involved. So Axie Infinity is, you can take it to its logical end of eventually when the demand doesn't increase at an exponential rate like it is, they have to find another way to create value inside of the ecosystem. But at first, to launch a new and novel technology like the way that they're doing it with play to earn, there has to be a way to incentivize people to get in. And so if you talk to Axie or if you hear what they're doing, they're really looking at trying to create now sustainable ways to recirculate yield in throughout the ecosystem. And how does people playing Axie now actually create value as opposed to more people equals more yield equals more value? Because at some point that kind of tops out, that peaks a little bit. It's the same thing in lending and same thing in DeFi.
Yeah, if you want to get the research, there's a guy named Lars Doucette, and he does the research on Axie, and he kind of created the numbers for this idea that Axie is growth dependent, right? So if there's no new users, then the ecosystem doesn't work at all. So that's entirely growth dependent.
Yeah, but it's similar to like
AKA Ponzi-nomics.
Well, if you look at Amazon and Uber and a lot of these other models, at first they're doing a lot of things either revenue neutral or in a lot of cases revenue negative, but it's all about getting critical mass and getting mind share. So lending and DeFi is kind of the same thing. In my opinion, we have all this liquidity mining on all these different networks provided by the network layers themselves from the foundations. Then us as protocols offer yield that's not necessarily, well, definitely not sustainable in terms of emitting tokens that we created out of nowhere. But at the same time, it's what you have to do to create interest, to create enough liquidity that the ecosystem can actually live.
Yeah, yeah.
And
It's
so, I mean,
interesting. It's interesting. It's kind of shades of what this gentleman said earlier, which is kind of VC, right? So if you look at kind of VC investment in something like Axie, you end up with subsidization of yield to the players, right? Almost to the extent like if you remember the early days of DoorDash, right? You could basically get like free deliveries, and of course it's like, how are they delivering food for free when it was previously not delivered for free? Like, what is going on? And it's it's VC money, right? So I think in a way it's kind of acquire users, monetize later. So I think you're saying a variation of that.
yeah, but I mean, to try to create a new financial paradigm, a way that is different than what we're used to as a society, I mean, you have to get enough liquidity to let things function properly. So, I mean, a new network, they offer a whole bunch of liquidity mining, which seems kind of like a Ponzi for a bit. And we all love it. I mean, if you know what you're doing and you're in early enough, you can make pretty incredible returns on that. But when you kind of zoom out a little bit and look at what we're trying to accomplish here, we have to create enough liquidity, enough activity in an ecosystem so that secondary, tertiary protocols can build on top of us and create real value and real yield because of real demand. But that takes critical mass. And I think we're at this interesting point right now. We're seeing Avalanche just did a huge Rush initiative. Solana's done stuff. I mean, we're about to see Polkadot probably do some interesting things if there's any Polkadot fans. But all of that really is, again, just like the DoorDash or the Uber. You have to get enough mind share in those ecosystems, enough liquidity so that then your secondary protocols can start building true value on top of what's happening. The demand right now is driven by, well, crazy yield. But eventually, which I think a lot of us are probably most excited about, is that the protocols will evolve now to be self-sustainable. Those yields will come down, but it'll be something that we'll see for years into the future, I think, where there's real yield driven by real value as opposed to liquidity mining. I'm sure somebody else has smart shit to say here.
Go ahead.
Well, I mean, the way I like to think about yield is that, like, if you look at the previous web platforms or any other business, really, there's the user acquisition cost for any business, right? So businesses go out of their ways to reach to that critical mass, to that level of growth, so that they can actually reach to like an efficient way of doing business. I think the novelty here is that it's the first time that so any Web 2 business, when they do that type of yield type of activity, the growth type of activity, where they are distributing value to early participants of a network, the value is generated in terms of that network's value, right?
Yeah,
But
that's amazing.
I mean, it's in the Web3 ecosystem. I think the novelty is that value generated within a new offering actually is translatable directly into real assets now, or real monetary value, right? So that's the pervasiveness of the new values that are generated, which makes things very interesting. So then we have this gold rush effect. That's less about the miles of United Airlines, but more about translatable value from one platform to the other.
Sid?
Yeah, I think with Axie Infinity, as Engine said, it's customer acquisition costs and using equity to finance the acquisition of those customers, so that Axie can reach a critical mass in its network density and then become more sustainable. But I think what's interesting is that when this business model reaches a mature state, it starts to look like a pretty financeable one. So play to earn, you have an initial investment, you then have ongoing cash flows that look like something you might want to finance with a loan or with debt. So I think I'd previously thought that maybe node operators or validators might be one of the first crypto native businesses that was going to be debt financed, but I think play to earn is probably increasingly likely to be that candidate. So I think pretty exciting for the lending space.
Seraphim?
I mean, the engagement coming from tokens and liquidity initially, they have big ramifications, actually in a good way. Like, we launched in the testnet a few weeks ago, and suddenly out of nowhere, 2,000 people show up and start trying out our platform, expecting tokens, right? So yeah, you could argue that it sounds like Ponzinomics and everything, but because of these tokens, suddenly everybody's trying out. We had second day, somebody translated our white paper into Chinese, expecting tokens like that. That's really amazing. It helps bootstrap the whole ecosystem, basically.
Yeah, and I think that's a super interesting point. I think Engine also said a similar thing about this kind of early network effects, belonging to the participant stakeholders. And, I think the idea of things like post facto second token airdrops are kind of really interesting, because at that point, you don't necessarily at the beginning even understand who the extraordinary value creators are. So it becomes almost like a awards ceremony where you're awarding post facto tokens, onto people who actually did create the network effect. So I think it's a pretty novel. And I think one of the reasons why in a DeFi panel you're actually getting attention onto this thing, play to earn, is actually because in essence one of the yield mechanisms is this entire growth, right? So the thing that I think is novel about play to earn mechanics is that you're actually getting net new users from gaming, which is 2.7 billion users, 54% of which are in Asia and the majority of which are on mobile, as opposed mobile first, right? So, Axie is almost kind of a perfect storm to capture a completely new user, not just into itself, but actually into crypto itself, right? So what happens with player guilds like Yield Guild, basically these people are being trained to become DeFi users. So the thing that I think is exciting is you have mobile user counts. So you have hundreds, millions, billions of users, right? But you have financial services lifetime customer equity, right? Because those people are being onboarded onto DeFi, because DeFi is the financial services platform for, I hate to say the metaverse, but I can't say anything else, right?
It's okay.
Web3, okay, Web3 is better. Sam.
It will be interesting though,
Sid.
because when Facebook first went to the Philippines, everybody who used it thought that Facebook was the internet. So it will be interesting to see whether people who start using Axie there think Axie is DeFi or crypto.
Yeah, or the whole,
Or just the whole
internet.
metaverse.
Yeah, Axie is the metaverse. Yeah, I like that.
I mean, from the point of onboarding the 8 billion people, right, it's actually really good because people don't get paid in dollars. They get paid in assets. And once they get paid in assets, you could argue the inequality is not so much of an issue as well, because as more people interact, the more actual assets with, upside they earn. So that's a word we should be embracing probably. So play to earn has done a really good thing from that point of view.
Yeah, I'm very glad to hear this, right? Because what we have on stage is like a bunch of like true blue, diehard kind of pure DeFi degen types, right? So in a sense, the thing that's interesting is that there is a welcoming wagon, right, for net new users, right? So in a sense, like, because I do think that one of the things that, I think if you caught the Alex Mashinsky talk, the thing that gets interesting is if there isn't growth in net new users, there really generally becomes infighting, right? Where basically, like some of the things that got really savage over the past few months has been protocol to protocol warfare, right? So we've seen like ETH killers, and we've seen like, we've seen a lot of sniping, right? So when you see sniping like that, it's generally a lack of net new users, right? That's the problem.
You need the pie to grow bigger. Otherwise, you're trying to just take a big
take it from
slice off
someone else.
Yeah,
from your neighbor, right? So that's an interesting phenomenon. So I guess to me, the thing that I think this brings us to as a question, and maybe one that's more apropos to the thesis here, right? Because one of the things we have here is this is yield and lending, right? So lending is kind of what we established pretty early on actually is that lending is a potentially durable and reliable source of yield, right? As opposed to some of the other kind of constructs, right? Of money printing and et cetera, and people getting wrecked. I mean, ideally fewer people get wrecked over time. Maybe they're kind of tied together actually, right? Because if people print lots of monies, then lots of people will probably get wrecked. So, but I guess to make a long story short, like, where does the people are now talking about DeFi 2.0, which is sort of a nomenclature that I kind of dislike. But given the idea of it is well, there's sort of what is the second generation of DeFi doing, and where are the kind of novel, exciting things to do, right? And I think a lot of folks on the stage are actually builders of that, and so I think would love to see. I mean, there's definitely like similar things new chain. So I think that's one approach that I've definitely seen. But what other kinds of like corners of things can be built out that haven't?
I mean, I think one thing that's in line with Ethereum or the general idea of crypto is permissionlessness. And that's something we haven't quite seen in lending, as in the gatekeepers. So if Ethereum holders do not really gatekeep the dApps that can be built on Ethereum, right? Lending, on the other hand, nowadays is like that. So perhaps it shouldn't be this way. Perhaps any asset should actually have a lending borrowing market by definition, a margin trading, a way to hedge your stuff, So I think the permissionless is probably a thing that could be, you could call a part of DeFi 2.0, being able to list any asset for lending market in terms of lending markets.
Make sense? Other?
So I think kind of dovetailing from the previous topic of yields, I think one question is how do you establish loyalty of participation, right? Because when everybody is running liquidity mining programs or distributing early tokens, airdropping, you kind of like end up with folks who are kind of chasing wherever the extractable value is. So now I see that, like, you guys may see that this people started calling this mercenary capital, right? So I think maybe the question is like, what's the evolution of that, right? So how do we evolve from here so that these early liquidity mining programs or early airdrops kind of translate into a loyalty of participants for your own network? So a few things that I see is that I think this is like where we will start seeing some fragmentation in offerings. And that fragmentation either will go into like, how do you convert your dynamics so that you actually establish systemically that loyalty within your economics. And I see that there are new services like Tokamak or Reactors or Olympus DAO or others who are kind of like offering these new ways of managing liquidity, the protocol-owned liquidity, as opposed to what they call the rented liquidity from liquidity providers. So that is supposedly that's going to create stickiness in the long run. I think that there's another avenue where we will see more fragmentation towards solutions that are geared towards specific, particular type of liquidity providers in the case of lending and borrowing. So, for example, like in our case, we primarily cater to institutions with the assumption that institutional adoption in the long run is mainstream adoption. So solving for the short-term institutional needs, such as figuring out ways to offer peace of mind through thinking about things like compliance or controls, or being mindful of institutional workflows and catering to specific needs like how they use multi-signature, or how they kind of use analytics or reporting. So this type of specialization probably is gonna start solving for that type of loyalty. That I think those are two different avenues.
Yeah, I mean, I think let's definitely keep going around where, as far as like where are the new angles. But I would like to kind of bookmark that and come back to loyalty in a moment.
Yeah, so I'll probably be a bit of a buzzkill here, but I think in terms of like, there's some great innovation happening in the space and some new novel concepts in terms of permissionless and how do we evolve that? How do we deal with under collateralized lending? How do we deal with wallet credit and identity? But I think first, you talked about same thing, different chain. What that fundamentally comes down to, I think, is managing risk. So most evolutions of technology over the course of time really are kind of step-by-step iterations on what seems to be commonly accepted as working. So, we've got some code bases throughout the ecosystem now, different chains that seem to be somewhat battle tested in different ways. So why would you create something completely new when you can take something that we know works to a certain extent and then iterate? So instead of having 10 people or 10 projects in different silos trying to iterate on islands, what we actually have is, a few of the same things iterating all at the same time. So you have a bunch of petri dishes looking at different solutions, different, innovations. But I think the next major shift for most of us, or at least how I think about it, is managing risk. It's the one thing that we talk about, listing any asset, and it would be amazing to have any asset be lendable and borrowable to manage risk and to hedge. But the big problem is, what are the second order risks of certain assets? We see exploits, we see flash loans. They were talking about that. So there's a lot of service providers coming up. Shameless plug for Chaos and Gauntlet and Halburn. But a lot of them are looking at, the technology risk, but then what's the risk of adding certain assets? What's the liquidity in the greater ecosystem? How do we bridge? All of those things are somewhat novel still at this point.
So I think, just to pile on what you're saying, I mean,
Sure.
I think the two things I want to link together in what you're saying is, really when you talk about things like under collateralization, right? Under collateralization is a form of risk also optimization, right? And in a sense, a lot of what we're seeing with under collateralization is, in some ways identity dependent, reputation dependent, right? And so, and kind of skewing towards the institutional side, right? So to me, the thing that's kind of interesting there is that actually opens a whole nother kind of cavern, right? Which is this whole construct of like capital efficiency, right? So, to me that, obviously capital efficiency is a whole nother, big can of worms, but, I think it's pretty clear that like large piles of total value locked is actually capital inefficient, right? So there's now kind of a pendular swing towards a desire to put more of that money to work instead of leaving it lying in big piles. So I don't know, Sid, do you want to? You can take this and you can either respond to this or you can jump on the previous track.
Well, I think maybe to kind of connect the two. So I think with DeFi 2.0, you're kind of looking at a theme of DeFi serving itself, like internally. So you have serving users without, which would be outside the normal crypto space, which might be, say, institutional lending. And that would very much fall into, capital efficiency and under collateralized lending. But then you have serving the internal DeFi ecosystem. And so I think platforms like Tokamak, like Olympus DAO, have sort of positioned themselves as products which serve DAOs, whether it be secondary liquidity or protocol controlled value. And I think now what you're going to see from the lending space, and we are seeing a few new projects trying to do this, is treasury management for DAOs, but also loans to DAOs for them to use in expanding their operations. So I think that's probably where lending fits into the DeFi 2.0 narrative.
Yeah, and it's fascinating to me, right? Because if you want to look at even further adjacencies, there's actually some very odd ones, right? And the odd adjacencies relate to things like insurance, right?
Yeah.
Because obviously it has to do with risk management, right? So the other odd adjacency are things like derivatives, right? Which also are a form of kind of risk, but it's kind of a decentralized mechanism, and adjacency to that is almost futures markets or prediction markets, right? And then so there, and then obviously another adjacency to that is things like security bug bounties, right? So I'm an angel investor in Immunify, and like that's clearly adjacent to this kind of concept of decentralizing the actuarial component of like risk. So I think highlighting what you're talking about, like risk and capital efficiency are kind of traveling together very tightly, right? And I think when you're talking about things like credit facilities for DAOs as a form of non-dilutive capital, that's risk capital, right? That's because when you're loaning money to some an entity that may not have existed like 2 weeks ago. So
yeah, and a lot of the challenge has been, can you identify a DAO that has recurring cash flows so that it could actually service the debt? Do you have a DAO that has a stable management structure? We've seen a few DAOs recently implode. And so, you want to find one who's going to be around for 12 or 18 or 24 months, depending on the tenor of your loan. No comment. But it highlights the elements of risk management that you need to solve for. But I do think for lending to expand and serve more of the retail market, because it was naturally going to serve the institutional market first, because you had economies of scale in assessing and due diligencing borrowers when you have to pay people to do that. You are starting to see more interesting tooling like credit scores, which make it more scalable to assess smaller loans and therefore serve a larger number of users in the DeFi space, on retail.
Yeah, and that becomes super interesting as a frontier, obviously, because there are things like individual credit scores, organizational credit scores, and then obviously this kind of dovetails too with the concept of stable identity, right? So if you think about identity, almost like physical identity and KYC can almost be a form of staking, right? Because in a sense, you have then a legal entity with possibly additional assets to pursue. Like you can basically like now go after the person's house as collateral after they've failed, So obviously it's dark stuff, but that's what TradFi does. So,
I think the idea of having credit scores in the base layer is a scary thought, because that means there's no permissionless in how to interact with the ecosystem, right? Now, if you had KYC and AML on top of that from a utility kind of a layer, that's fine, as long as on the base layer you can access everything, because otherwise, you have to have a credit score in order to interact with anything, and that's just
yeah. I think that was kind of what I was alluding to, right? Which is this idea that, of course, DeFi intrinsically can be kind of completely pseudonymous and anonymous, right? And so then in order to access improved credit, you can actually do things like, wallet proofs, and then you can do even more aggressive things like, human identity KYC proofs, right? Because that actually gives even more staking, right? So I think that's kind of perhaps a mindset that allows you to potentially under collateralize more and more, right? Because then you have something that you can pursue. One of the amazing things about under collateralization based on identities and things like credit lines to DAOs are things like collections, right? So I mean that's something that DeFi has never, because in DeFi, kind of the magic DeFi concept is automated liquidation, right? But like if you've loaned money to a DAO and they've spent it all on salaries, like what do you do now, right? So in a sense, is that still DeFi? Anyone?
Well, I think it is, because it's still decentralized infrastructure. So DeFi doesn't necessarily need to be permissionless. Like I think it,
and it doesn't require automation or smart contract necessarily.
Yeah, I mean, it uses it where it's relevant and where it solves a problem. So DAOs are, using a new tool with smart contracts to coordinate people.
So would you be okay if it turned out that the most capital efficient deployment of credit lines is actually a banker sitting at a desk approving loan applications?
What do you mean?
What I'm saying is that like, how do people get loans, right? And so if you go to TradFi, you actually sit across from a banker and you hand them a loan application, and they look at you, they probably, have thoughts about like, what you look like, and they probably are they're doing wrong things, right? And that's kind of upsetting, right? So in a way, DeFi is kind of like, okay, let's just automate things and get away from those bankers and get away from that assessment, right? But when you were talking about kind of credit facilities to DAOs, you're talking about, oh well, so how's the management team and how stable are they, and do they have experience? All of a sudden you're like back in the chair as a banker judging people and being like, should I give you a loan or not?
Totally.
Okay. Yeah. Sounds a little TradFi. The other thing that's
no. But I think if you get to it, you're making an assessment of a propensity to repay, and so you're trying to evaluate. Like the concept of a banker approving someone for credit is not what's broken. It's all the processes and the infrastructure that sit behind that, and the broken incentive structure. So I think what DeFi has the power to do is to correct that. But the decision to lend somebody money is still, can still be based on judgment.
Yeah. So what's fascinating is that, DeFi 2.0 with the idea of like increasing capital efficiency, right, is actually now leaning into something interesting, which is counterparty trust, right? So the idea becomes that trust is capital inefficient and lack of trust is capital inefficient.
Well, I don't think we're talking about DeFi 1 and DeFi 2.0. I think we're talking about uncollateralized and collateralized lending. There's just different businesses. For uncollateralized lending, it makes sense you have to vet who you're lending to, right? There's nothing wrong about that. I mean, otherwise you could just give money away, right? Well, we're not doing that. Collateralized lending is somewhere where you're not supposed to, because you have, assuming the collateral is of decent value, and that's where risk management comes in. If the collateral is a high value kind of asset, you don't need to do all that stuff, right? So I think these are just two different ideas of lending.
The reason why I've kind of like categorized it in this chronological way, 1 and 2, is because really the preponderance of DeFi lending up to this point has largely, the earliest phases of it have been over collateralized, on chain, and kind of like instant like collection liquidation, right? So that's been the hallmark of traditional DeFi, right? So in the name of capital efficiency, what's creeping back in is this concept of counterparty trust, right? And if you think about whether that's coming from actuaries or whether it's coming from smart contract auditors or whether it's coming from bank lenders or, whoever it's coming from, there are analysts that are studying something and deciding how much risk they're willing to take and how much kind of collateral they're willing to accept.
I think maybe like one thing to add on to that is that like we can think about ideas like credit, insurance, compliance. These are all potentially could be decentralized to a certain extent as well. And back to that idea of like, how do you evaluate someone's propensity to loan out money, is that I think that's becoming more and more relevant because the desire to borrow or the amounts, the desired amounts to borrow are increasing, right? So that's why the stakes are increasing. And for that reason, like we actually start seeing the emergence of like folks who are kind of like trying to mirror this idea of credit scoring. I would say that in the beginning, it's likely to mimic how current credit scoring mechanisms work. And we are likely to see more native DeFi credit scoring mechanisms. Like there are initial versions of these actually. So like we are likely to see those turning into oracles. That's like what I'm seeing more and more. And we will be seeing the separation of the streaming of those raw materials and the assessment of those raw materials. They don't need to be done by the same people, right? So in just like a very simple case, somebody may be streaming different types of material that informs a credit assessment ultimately, and another decentralized mechanism could be taking those inputs and deciding depending on what their level of comfort is. And I don't think about these as like a binary uncollateralized versus collateralized. We should think about it as a spectrum. So we are likely to see more and more of like, is it 125% or 110%, or is it like 80%?
Yeah. So I appreciate this spectrum model, right? Because is it Engen? Engen, yeah. So your firm actually does institutional lending types of mindsets, right? And if you actually watch the keynote speakers this morning, right, what you notice is that you have Stani, right, who's doing Aave, right? And what did he talk about? He talked about ARC, right? So what is ARC? ARC is, okay, so DeFi is moving what? Towards CeFi? That's interesting, right? But then, later on you had Alex Mashinsky. What did Alex talk about? Alex talked about Celsius X, right? So it's sort of like, oh, well, so the CeFi is starting to move towards the DeFi, right? And so the thing that I think is interesting about this kind of drive towards capital efficiency is this idea of hybridization, right? Because here's a funny thing is, if you look at things like insurance, right? The thing that's so interesting is what is a mutual, right? A mutual centralization, right? It's centralization because you actually need a sizable pool to cover like losses, right? So people are coming together, they're forming a large thing, right? But the thing that's interesting is that the actuarial function is decentralized, right? So if you go to traditional insurance, you're like, well, that actual function, the actuarial function is actually centralized, except it isn't. And what I mean by except it isn't is that the market actually affords this concept of there being multiple insurance companies, and the one that's really crap at actuary will just die, right? Because they just won't know what to insure, and they'll just insure all the wrong things, and then they'll fail and they'll run out of money and die, right? So in a sense, like even traditional insurance and TradFi has a measure of decentralization, which is in the form of market competition between insurance companies, right? So what I'm trying to push on here is that we're seeing synthesis occurring in front of our eyes, right? So, and the thing that's amazing about when you see is, to me, like the target of going after like sort of TradFi or even going after more CeFi styled institutionals is really that like we've kind of run out of people with MetaMask doing XYZ. Like that's what I think. So I think that that's the frontier has become sort of play to earn, which is net new users who aren't kind of MetaMask DeFi nerds, and then also institutionals. So those become kind of the growth frontiers. I mean, fight me if I'm wrong.
I would say that, I mean, we can think about adoption as like, again, another spectrum where on one extreme end, there is the complexity, the proliferation of services, DeFi 2, how do we make things more efficient? How do we, just build upon each other's services, how composability works. And I think that caters to a crowd that's like more and more limited, right? Because there's complexity, there's a high barrier to entry. On the other end of the spectrum, there's the barrier to entry, like how do you lower that? So that's like another part of adoption comes from. And that's like where I think all of these centralized parties coming into the picture, that's what they will be enabling, is that there's a crowd that may not be using MetaMask anytime soon, right? So how do you actually enable those people to maybe in the beginning indirectly benefit from these services and get up to speed as they interact with these centralized parties through the interfaces, through the products that they are familiar with, and get up to speed with the concepts? That's, I think, how I'd like to think about that. These are coexisting. They're not mutually exclusive.
I mean, I'm kind of happy to actually hear a reasonably conciliatory tone, right? Because in a sense, like, I think in the earlier days, there was much more of polarization between like centralized versus decentralized. And there was much more kind of religiosity around that topic, but I actually think that that's been subsumed by pragmatism, right? Which is, I think that people want to build things people use. And, if some of the users are institutional, that's probably okay as well, right?
I think it shows that maybe you're right, that DeFi is maturing. When you think about what you have in TradFi and DeFi, you have, let's say, exchanges, we have lending markets, permissionless options, futures. We started to have that too. At the end of the day, I think the biggest challenge in DeFi so far is probably Oracle pricing. That's something that hasn't been properly figured out. But apart from that, you could argue that we replicated TradFi really. Like I'm seeing CDS structured products already in DeFi. Like that's kind of nuts, right? But I guess the next frontier is indeed the fact that it's the infrastructure for what's to come, which is the metaverse probably. So once people are able to interact with the metaverse using the DeFi infrastructure, probably that's the next frontier. While DeFi has already kind of matured really and is ready to fulfill that purpose.
Yeah, I think that's a nice thing, a nice statement, and it's definitely a frontier statement. I think Stani tweeted the other day this idea that the financial system by itself is not the goal, right? So it's a funny thing to say, but then it's like, okay, well, what is this decentralized financial system for, right? And I think you kind of indicated that there may be kind of metaversal aspirations to effectively build an economy on top of decentralized finance, is a decentralized economy, right? So it's more pure digital asset and pure digital realms.
Yeah, I think that's right. I mean, in traditional economics, you talk about the financial system as being a kind of tax on the real economy, where maybe it takes 2% of GDP a year. And I think the way that you want to think about DeFi is that it can kind of either support the real economy, and hopefully also support a metaverse economy being built on top, which takes advantage of, the ease of access to a digital first financial system, which is what we're trying to build.
Yeah, I mean, I think it's interesting, right? Because one of the things that we're also seeing with these kind of new tokens is, we're also seeing kind of NFT land, and we're seeing, NFT land sales in games and the, metaversal environments. So it's in a way, this kind of land grabbing feeling is kind of an interesting feeling, and I think there's big pros and cons to it. I do think that a lot of NFT assets themselves will probably end up being, completely illiquid. So, there is a certain amount of that going on. But, I think in the long run, I think it means that people are placing their faith in the blockchain, right? Because they believe that it is a high fidelity consensus history recording device, and that, hundreds of years from now, anyone can look at the record and see still who owns what. So I think that's the idea that this is a durable record and a relatively permanent record gives people some confidence that they actually own something. So I think that's sort of the basis for metaverse.
Well, I think the connection is that also DeFi is fundamentally more connective than the Web 2 financial system. So if you've got people playing play to earn between Philippines and the US and Canada and parts of Europe, they don't want to use a financial system to transact with each other that is going to take, T+3 days to settle any transaction between them and cost 5% every time they want to send some money between participants. So DeFi is naturally very aligned and I think symbiotic with the rise of play to earn and other, metaverse concepts.
Yeah, I think like speed is innovation. Like you could travel by horse or you could fly, and suddenly the range
send an email.
Or send an email, but the range of possibilities just expands drastically, basically, because of that. So DeFi, you could argue maybe it doesn't create anything new, but because it does it 1,000 times faster, they can raise like 40 million to buy a freaking paper like in a week, in a decentralized way. That's probably progress. So I think speed is really important in DeFi, and it's a big source of innovation.
The paper being the Constitution.
I think maybe like one question that comes up with all of this is that it's not new that there's like a sort of a creative destruction going on, but also in parallel to that is a mimicking, and probably subsequent to that is the cannibalization of centralized finance. I don't know what time frame this takes place, but one question is that a lot of mechanisms that we know from centralized finance will be mimicked and transformed into something that caters to a similar function. So credit being one, identity being another, compliance being another, or assessments being another. So I think one of the interesting things about DeFi is this fundamental interoperability, the composability, or money Lego bricks, whatever you want to call it. As these new enablers and structures are getting into place, like how do you maintain, how do you preserve, or even build upon that idea of composability and not harm that? I would say that that's the holy grail question and the big opportunity space.
Yeah, I mean, I think that really what you're alluding to is fundamentally having a framework for evolvability, right? So kind of maximally evolving this framework. One of our investments is Agoric, and they actually have this modular security assertion library that enables you to. So the smart contract language there is JavaScript, but like to me, the thing that's so interesting when you have modular security assertion is you have like composability while maintaining security, right? So then you have like, I think, proper money Legos. But I guess what I wanted to do, it sounds like are we getting the hook? Okay, it sounds like we're approaching the end. So if anyone has parting shots about kind of the future of DeFi, like take them now.
Freedom, most important thing. So we should keep it free.
Yeah, freedom is definitely what we get out of blockchain, and we get it for free. Any others?
Well, I think over 2022, you're going to see more institutional participation, but you're probably going to see more interaction between DAOs and existing DeFi lending infrastructure. We already talked about some of the use cases that are emerging, but I think the amount of resources growing in the space is going to drive more of this, as well as the increasing number of new products that are just available for DAOs. We're seeing a lot of DAO tooling startups emerging, and so DAO lending is naturally going to be something there as well.
Yeah, and I'm excited about that because we were talking about DeFi being the financial system for what, right? And I think in a sense, a DAO is kind of like, well, it's the DeFi is the financial system for DeFi, but some of the DAOs will also be doing anything, right? So that I think that's where it starts to merge with the real economy. I think that's pretty good